Is my voice audible? Good morning, guys. Okay, I guess it is. So, welcome everyone to the 16th webinar of our 24 in 2024, the Changemakers of India series. My name is Tanisha, and I'm delighted to be your host today. As part of our ongoing effort at Whiteboard Foundation to bridge the gap between education and the corporate world, we have curated this exclusive series featuring 24 industry leaders who have made significant contributions in their respective fields. These sessions are designed to provide you with valuable insights, guidance, and practical knowledge directly from the changemakers themselves, helping to equip the youth of India with the tools they need to succeed in an increasingly competitive job market. Our guest speaker for today's session is none other than Mr. Sahil Sharma, a distinguished alumni of IIM Kozhikode, where he earned the rare honor of being a double gold medalist. Currently, he is an associate at Synergy Consulting and previously served as a rating analyst at CRISIL. His journey is a testament to excellence, hard work, and a relentless pursuit of knowledge. Today, Mr. Sahil Sharma will be introducing us to the fascinating world of financial modeling, a critical skill for anyone looking to excel in the finance sector. Whether you are an aspiring financial analyst, a student keen to explore this domain, or a professional seeking to sharpen your skills, this session promises to offer valuable insights and practical knowledge. So, without further ado, let's dive into this enriching experience and learn from one of the best in the field. Please join me in welcoming Mr. Sahil Sharma. Before we start, I would like to inform everyone that your mics are muted. So, if you have questions or we will be having a Q&A session in the last 15 minutes where all your doubts will be answered. Now, the virtual stage is all yours, Mr. Sahil.
Thank you, Tanisha. Thank you for the kind words. Uh, I hope my screen is visible.
Yes, it is, sir.
Yeah, thank you. So, starting, uh, I think you have introduced the topic very well, financial modeling. But before we start with the discussion on financial modeling, I would like to, give a brief uh, introduction of myself and about my journey so far. So I did engineering from YMCA University, Faridabad, in back in 2013, and at that time I was much more interested in finance than in computers and coding. So I decided to switch fields and move to finance, and I so I enrolled in a one-year program at National Institute of Financial Management, Faridabad. It was a program specifically focused on financial markets and where my interests lied. So this program kind of introduced me to a lot of new concepts because I was fairly new at that time. So, uh, so that got completed in 2015, and after that, I started on my own. I got registered with Amphi as a mutual fund distributor and worked as a mutual fund distributor for about 2.5, 3 years. And alongside that, I was also appearing for the CFA examinations. The reason was mostly because I wanted to, delve further into the field of finance and, make my concepts much more stronger than I felt were at that point in time. So I passed the level 3 of CFA examination in 2017, and after that I joined ICSE Prudential AMC in their customer engagement channel as a relationship manager. So it was a very, I would say, an interesting job for me because I was not somebody who was very interested in sales, and I would say that by far that was one of the most learning experience so far because uh, once you go and do something that's uncomfortable in life, you tend to learn a lot more. So after that, I worked there for about 2.5 years, and Then I went to do MBA from IIM Kozhikode, which got completed last year in 2023. Post that, I was working with CRISIL as a rating analyst, uh, and my primary job was to understand the business, the sector they are in, and recommend a suitable credit rating to the ratings committee, which uh, which would get published in the public domain. So I've recently switched, and in from June onwards, I've been working with Synergy Consulting as an associate, and there the job profile mainly focuses on consulting clients which are undertaking projects and focused on project finance. So yeah, that is a fair bit about what I have done so far. So today's topic is a very interesting topic. This is something that you don't get to learn at an undergraduate level, but it is something that is really important for somebody who is entering into the field of finance. So financial modeling, I would say, is one of the core skills that you need to build if you wish to pursue a career in finance and decision making, etc. So without further ado, let's uh, you know get into the topic and discuss further. So sorry, I'm not able to see any comments, etc. So I'll just want some answers from the audience, like what do you think is a financial model? So if you can put it in chat, like what do you think is a financial model exactly? Anybody? Nobody?
Come on, guys. Whatever you think it is, you can write it down in the chat box.
Anything like what does a financial model do? What do you think a financial model is? Uh, like why do we even need a financial model? Anything that resembles to you, like whatever comes to your mind, you can put it down. Yeah,
Mr.
just
Sahil, can you access the chat box? Are you able to see it?
I am not able to, like, I can access the chat box, but I've just one message from Sagar, so I'm not sure if anybody else has put
Yeah,
in.
because see, that's okay if if you're indulged in this session, I can read out to you whatever like the everyone is writing in the chat box. If you want me to, I can read it out to you.
Sure, that would be great.
Okay, so Umesh Singh wrote overview of finance, how to utilize it in effective manner. That's good. Sagar also wrote it's the study of all assets of company.
Okay, great. Fine. So I'll give you my take on what actually a financial model is.
Okay.
So this is what I think it is, and it's basically a quantitative sneak peek into a company's future. So with a financial model, what you are trying to do is understand where the company is today or a project is today, and what will it look like in the future. So it's nothing short of you know predicting the future, and that's exactly what a financial model does. uh, we'll go ahead and discuss what all like how you go about and do it, but the crux is this only. So a financial model is something that helps you take a look at the future and how it would look, and then there would be different use cases. So again, my next question would be, who do you think would need a financial model? If there are any answers, can you please read out, like, because I cannot access the chat.
Yes, yes, sure. To the previous question Afreen wrote, financial model is all about to manage your money in systematic way.
Okay.
Yeah.
Manage my money would be a bit, I would say, yes, you can do that. But
Hmm.
overall, when you look at the larger scheme of things, it's about what a company is doing. So you are looking at a company's performance and how it will do, not necessarily your own personal finances. But yes, of course, you can use that. So
Yeah.
now I would,
Um,
yeah.
okay, okay, continue.
Sure. So yeah, if there are any answers to who do you think
Yeah,
would need?
actually, Mehak wrote, you
Yeah.
asked who needs a financial model. Mehak wrote investors.
Okay. Okay.
Yep.
So let's see who all needs a financial model. So anyone, actually anybody who's taking a financial decision would need a financial model. So, Mehak, you are right that investors, so equity investors need it. And why do they need it? Because they need to value companies and they use it for valuations, uh, not just, and if we are talking about the broader subset, broader, set of investors, it's not just equity investors, it's bond investors as well, debt investors, creditors. And but if you see their use cases are different. So while uh, you know uh, an equity investor would want to value a company, want to understand what is the share price of the company, a bond investor or a creditor, by creditor I mean banks or financial institutions, so they are they are much more interested in whether a company will be able to repay their debt obligations in the future, and that's what they are looking for. They are trying to understand how the company would do and would they be able to repay me, should I put my money in there. So that's my overall, so for an equity investor it is mostly the use of a financial model is to derive the share price, whereas and share price through maybe different methods are there. Uh, you may be doing comparative analysis, absolute valuations, DCF valuations, etc. On the other hand, a creditor would be much more interested in the ratios in the future. So, for example, debt service coverage ratio is something that they would be looking at going forward. And if you look at any credit rating reports, so these are the ratios that would always be there. Like how much is the leverage, what is the debt to equity of a company, or a debt service coverage ratio. I hope, in case I am saying something which you don't understand, feel free to ask those things later in the Q&A session. Then the corporates need it. So any company that wants to take a strategic decision, wants to understand whether, like, whether I should put a plant in in a specific place or not, like how much would my revenues increase, what would be the cost. So for that, corporates need a financial model. Then investment bankers, so any IPOs, etc., that you see in the market, an investor is investment banker is are the ones who are running the show there. So an investment banker needs to understand what is the value that they can, get from the market. So they are selling the shares of the company, and for example, a company, they are pricing an IPO at 1,000 rupees, but the worth of the company is in the minds of the investor, it is just 200 rupees. So the IPO will never go through. They will never get the money that they are looking for. So for investment bankers, it is important to value these companies, and again they need a financial model. And then entrepreneurs. So I understand that a lot of you are in college or just out of college, and some of you would be dreaming to start something of their own, of your own, and start your own business. At that point, you cannot just go with the gut feeling. You need to have proper analysis of what all your revenues are going to be, what all your costs are going to be, how much are you how much would you need to invest in the business, and what are your returns going to be. So for all that, basically, to understand the feasibility of the business, you have to take the help of a financial model. And like earlier somebody mentioned that personal finances, I think that's also an important area that people can actually use financial models. So you can take decisions such as whether to buy a car or just take an Uber to the office every day, or maybe whether to buy a home or rent it. So you can put it in a Excel sheet, forecast it and see whether what makes sense. So absolutely, that is also something that you can do. So now we look at what are the key components of a financial model. So there are when you look at a financial model, it can run into tens of, or ten, like as low as 3 to 4 sheets in an Excel workbook, to say tens of sheets, depending on how complex it is, like what all calculations are going to be there. But if I have to divide all those sheets into certain categories, so there are basically four categories. One is historical data. So if you are like our equity investors and bond investors, they would have certain prior information on the companies, and that information is the base that you build that model on. So historical data is something that has to be put in very precisely and accurately, uh, and the best practice for putting in historical data is to uh, you know put in all the numbers that you can see for a company. So historical data is something that is that goes in a financial model. And the second, and a very important, and just going back to historical data, so it's not necessary that you will always have a historical data. So for example, somebody starting a new business, or maybe starting a new project, they would not have any historical data for the company. So it's not a I would say it depends on what you are valuing or what you are projecting. So historical data may not be available for all the projects. So how do you build a model if you don't have historical data? So assumptions are one of the most important things in a financial model. So assumptions can be about, again, what are going to be your cost of investments, what are you going to be your requirements in terms of working capital, then what are you going to be your revenues, what are going to be your costs, and how do you project them, like how are they going to grow, what is going to be their growth rate, what are your tax assumptions, what are your depreciation assumptions. So as everything that flows into the model comes from assumptions. So assumptions are the drivers of what is going to come out. And what actually comes out are two things. One is the forecasts. So forecasts are usually financial statements. So you have developed a profit and loss statement, a balance sheet, a cash flow statement from whatever historical data you had and whatever assumptions you had. So this is something that you kind of look at, and then the most important thing that comes out as the output. Output could be valuations, ratios. I've just mentioned two, but this could also be, uh, a pictorial representation of the data. So, for example, you will use a chart to show, okay, how much is going to be the revenue over the next 5 years, and what is going to be the operating profit or net profit, and maybe profit margins, etc. So pictorial representation, just to understand what is actually going to happen with this. And then and then sorry, and then you also do some sensitivity analysis. I've not mentioned it here, but that is also very important. And I think later on in the presentation, I will discuss why sensitivity analysis is important. But yes, so this is how a financial model is built. You put in historical data, you put in assumptions, and what you come out with is forecasts, financial statements, and then outputs in the forms of valuations, ratios, etc. So now, what actually makes a good financial model is four things. One, I think there would be other things also, but if I have to break it down into the four most essential things, it would be simplicity. One, simplicity. Simplicity means that you do not unnecessarily create a lot of formulas and make the model very complex. Because what happens is that when you go back and you have to change something, you don't maybe so one scenario is you go back, you want to change something, and then you don't you it again takes you a lot of time to understand, okay, what did I do and like how was it working. Second is, if you are not going to be the only person who is going to look at that financial model. You are most probably be sharing it with your superiors or clients, or maybe like as you mentioned, maybe there are other stakeholders like investors, etc. So when you're sharing these models with them, it might be very difficult for them to understand what is going on in the model. So keeping it simple is very important so that you also understand and the other person who is trying to look at that model understands that model well. Second is robustness, and by robustness I mean that your formulas etc should be really accurate in terms of when you are trying to change something in the assumption. So anything that you change in the assumption should flow in the three financial statements and then in your outputs etc. And when you are making those changes, the model does not show any like the flow is pretty, I would say, smooth. There is no errors that are coming out. For example, your balance sheet does not go mismatch. Like everything is in place, nothing is out of order. So that is very important. And that only comes in when you understand the formulas well, and you're linking it to the right cells. So that is the other thing. And then it should be free of errors. Like I mentioned, robustness and free of errors is something that go hand in hand. So you see that, okay, just an example that there was a value in assumptions, and you change it to zero. So somewhere in the model, there would be divided by zero error, or maybe you just delete a row and which was referencing to some other cell in the model, and then you see that hashtag ref error. So all these things you need to take care of when you're building a financial model, and all these things are kind of your technical, these look at your technical skills. The most important thing, and I think I cannot emphasize is emphasize it enough, is your quality of assumptions. So if your assumptions are not right, no matter how good your model looks, no matter how robust it is, uh, the engineering would be very top class. But if your assumptions are not right, the model is like worth nothing. Because, so I'll just give you an example that uh, a lot of like there are a lot of internet companies that are coming up in India, and people have been valuing them at a very high rate. I'm not saying that is wrong, but the point is that how do these valuations come out? These valuations come about from a financial model. On the other hand, we had seen like a couple of years ago, PSU stocks were being valued very low. These valuations also come from a financial model. And then what we are seeing today is that all those overvalued companies are not doing that great, and all those PSU companies are doing well. This may be temporary, but my point, my larger point is that if if what you are putting in, what your assumptions are not right, maybe you will not arrive at the best decisions. Similarly, a lot of entrepreneurs, fail because they overestimate what they can do. So when they are making a financial model, they will put in very high numbers for growth. They will uh, put in, you know, high profitability, etc. But when they hit the ground, the reality is that that growth number may not be achievable. That profitability number may not be achievable. So the larger point is that if you have to do very thorough research, uh, and research is also part of a financial model. It is not just an Excel sheet. You have to do a lot of groundwork. You have to understand. I think we'll come to that in the next slide. But yes, you have to be very thorough with what you are putting into that model, and then what is coming out. So the essential skills that you need for financial modeling is, one, your understanding of financial statements should be very good. So you need to know how a profit and loss account, you know, is connected to the balance sheet and the cash flow statement, and how the cash flow statement is connected to the balance sheet. So all these things should be very clear in your mind. What comes where, how, uh, if I change a line item in the balance sheet, what impact would it have on, say, my profit and loss and cash flow statement? So that is, I think, one of the very basic core skill that you need, without which you cannot make a good financial model. Second is understanding business models. So you would be making financial models for a different kind, for different kinds of companies. So an IT company and a manufacturing firm vis-a-vis a company that is into, say, pharmaceuticals, or a real estate company. All these companies have different business models, and if you don't understand what drives the business, maybe you will struggle to make a, solid financial model for them. So you need to have a very solid understanding of what drives a business, what are the, you know cost factors, what are the revenue factors, why one company has to do a lot more investment than another company, and why are they being valued at the same levels. So these are things that are, and again, the treatment of some of the line items would be different for, uh, like, for example, something that is an investment for one company would be an inventory for another company. Something that is other income for one company would be core income for another company. So you need to, understand what, like, these thin, I'd say these are very important things. They may not seem very important, but once you are, you know, uh, getting into a model, and if you're, you know, again, putting something in an investment while it should be an inventory, then it's like you have made a blunder. So yeah, that is important. Second, you need to understand valuation techniques and, ratio analysis. You should be good with what, all the ratios. uh, what does a ratio signify? When I change something, will it impact my ratio? If it does, how it does it? So that should be very clear in your mind. Valuation techniques, your, DCF valuations, etc. So understanding concepts like free cash flow uh, and discounting, so return on investment. So these are things that are going to be your outputs in the model. So if you don't understand them, maybe again you will not be able to link it properly and give the right picture. Then data analysis and presentation. I think that's, since we are working with numbers, that is very evident that until and unless you are able to analyze those numbers and present them in a proper format, because you cannot go and show a 20 tabs Excel workbook to someone. Like they will get confused. Like what the hell is this? So you need to put it in maybe graphs and tables, etc., so that the person that is who is the end user gets to understand in a very easy and concise manner. And you need to understand that if you're doing it for somebody else, then they are paying you to build that financial model. So if they understood what you understand, they wouldn't need you. So that is very important. So data analysis and presentation is very important. But I think it's very evident since we'll be working with numbers. And at the end, Microsoft Excel or uh, any tool that is, I would say, spreadsheet tool. So these are the basic, and they have been in business for, I think, for a few decades now, and we don't see any change in that. Like I think 10 years down the line, also maybe Excel would be something that would be required to build a financial model. So it's good to start learning, start exploring, and try to understand the formulas and how you can, because people who don't understand and I think nobody knows all the formulas. Even I don't know all the formulas. So sometimes I would struggle, like I would make something very complicated just to arrive at what I want, whereas Excel may have a ready made formula to do what I wanted to do. So that point about simplicity, I think that that's only possible when you know the tool that you're working with. So how do you go about building a financial model? I think first of all start with data collection, gather historical financial data, do market research, uh, and then start putting in your assumptions. Uh, Assumptions would be for growth rates, costs, and variables, like other variables that we had discussed earlier. So once you have the data in place, once you have your historicals, your assumptions in place, then you go about building a model, and then you start linking everything with your model, your future model. So you will already have a lot of numbers in place, for example, for profit and loss, etc. But then you will link it with, say, growth percentage, and then you build on that model. So then comes the uh, step of model building. Then you have to validate it, like ensure that again model is accurate. You do a lot of testing, change numbers, and then validate it that okay, I'm fairly confident that okay, this will work. Then you do scenario analysis. So scenario analysis is important in the sense that, like I mentioned earlier, that what you are doing is predicting the future of the company. And had we been, such good at predictions, we would have been the richest people in the world. But that is not the case. Everybody is making those assumptions based on whatever they have read, whatever they understand, and they can be wrong. So the one thing in finance that you need to understand is that you cannot be absolutely right. There is always going to be some, you know, uncertainty. You don't know when COVID will strike, when there is a war. So these things are going to happen, and there is absolutely no way you can predict the future, although you are trying to. So, what we are trying to do with the model is making a best, I would say, best case guess or the best guess possible. So, that's what we are trying to do. So, in that case, when you are, for example, taking a 10% growth rate, you also need to check what will happen if there is a 7% growth or a 5% growth. And then you also need to see what will happen if there is a 15% growth. So all these scenarios you should build in the model. Uh, it's a very simple tool. I think if you go in Excel, there is a option of data tables. So with that, you can easily change one variable and see, okay, one or two variables, you can see that, okay, if I change this, what happens? And based on that, you take a decision. So it's not that one number that you have put in your assumptions. And everywhere you go, it's a best practice to have various scenarios in place. So that's very important. And then reporting again, how you present it, how you so that's the final step of building a model. So I'll just show a couple of examples. They're very simple models I built some time ago. So this first example is a simple model of a company. It's a paper company, and what I tried to do was put in assumptions, forecast the profit and loss, balance sheet, cash flow, and do some valuation. So it's not a very extensive model, but yes, you'll get some idea. So here I have taken, so the sheets that I have are assumptions, operating parameters is basically uh, it links to your sales numbers. So you derive your revenues from that profit and loss, balance sheet, cash flow, financial of peers, and then financial analysis, basically ratio analysis. And then beta, you need beta to use in your valuations. So that's I'm not going to go in that, but then you have another sheet for that, and then valuation. So this is a sample of the assumption sheet. Here you can see I have sales volume growth. Then I've calculated what would be the realization. So cost of goods sold, what would be the employee cost as a percentage of revenue. Then what is going to be the capex for the next 5 years, receivable in days, inventory. So everything is put in here. Your debt schedule. So what would be the opening debt? How much are you going to repay? What would be the closing debt? What is going to be your cost of capital? So all these are market research numbers. So if you see, I've taken the risk-free rate as 91-day T-bill, and there is a lot of, uh, I would say, debate on what should be the risk-free rate. So that's something that you need to, uh, like, you take your own judgment call. Beta of stock, then cost of equity, weighted average cost of capital, what are number of shares outstanding, terminal growth rate. So these are some of the things that you put in a assumption, and it's a very small, it's a very basic model. So this is your operating parameter. So I've tried to forecast what would be the total capacity, how much would be the sales volume, what would be the realization, and what would be the EBITDA of the company. Then you see the profit and loss, like you link everything to the profit and loss statement, which is, so I had, this was I think way back in last year 2023. So I had only 9 months FY23 numbers, and so using that I had forecasted for FY24 to FY28. Then you go ahead and forecast the balance sheet. So again, numbers till September, because your balance sheet numbers in the Indian context are published either half yearly or annually. So so the numbers were available till September only, while the PNL numbers were available for 9 months. So that you forecast again, use the use your assumptions, etc., and then forecast. And in balance sheet, what usually happens, you will see that So for example, in non-current asset, property, plant and equipment would be a number that is changing, but most of the other numbers are constant. So that is done because these numbers are very, I would say, uncertain to predict. You cannot predict, okay, what would be like how much a company is going to invest in financial assets. So you don't try to predict that as well. So you just pick up some of the key, I would say, line items. For example, property, plant and equipment, inventories, uh, then cash, and on the liability side, borrowings, payables. So you take these numbers and just keep the rest constant and try to uh, change these numbers and see how it will look. Then your cash flow statement. So nothing unusual here. So again, use your EBIT, NOPAT. Like this is a valuation, DCF valuation. So I have kind of shaded the value, etc. because I didn't want to share that, but yeah, you use the FCFF method and then calculate. So this is the output of all the work that I've done. Then the second example is a project that was happening. It was a parking project. So here the here I've just put in only the assumptions that I had used, just to give you an idea of what all can uh, what can be if a project is a little complex. You're trying to set a context for something that is being built very new. So in that sense, there are a lot of assumptions. So this is like you're putting in the facility details, how like when will the like investment be done, uh, work completed percentage, what would be the time frame, etc. Then I have put in the capital expenditure. Okay, how much would be required for say fencing, for groundworks, zoning, signing, construction. So what would be the total construction cost? Then you go to the operational expenses, like going forward, what would be the for different line items. So wages and lease were the two main components. So that is what we have tried to forecast. And then what would be the annual wage growth? What would be the annual growth in lease expenses? What would be the management salary and some general expenses? So I have also put in the number of payable days right at the bottom to use for trade payable. So since this was a services business, you wouldn't have account receivables or inventory. So payables was the only working capital item. Then you have your revenue model and cost of capital. So again, so this is something, and again I would say this is not the like you can have much more vivid or much more complex models where your assumptions can be, you know, the number of items that you're putting in the assumptions could be much more. So I think that was it. But at the end, again, I would put in a word of caution, and it's a very famous quote that a great deal more fiction is written in Microsoft Excel than in Microsoft Word. The source is unknown, but this is true because I can show you any story about a business by just changing my assumptions. So if I want to sell you like sell you shares of a company, I can just say that this company is going to grow by 30%, and Excel would show that yes, the valuation looks cheap at this point. Or maybe if you're a banker, I can show that my profitability is going to be so strong that there is going to be no issue repaying the debt. So it's all story, but at the end, it may or may not pan out. So again, I think I will part with the same thought that your model would be as good as your assumptions are, and you will only be able to take a right decision if you have done your research well, and if you have done the groundwork to understand the business, and how it would look like in the future. Otherwise, you will put in any number, it will come out, and you will believe, because uh, it's also a matter of belief that when we see something, in black and white, we tend to believe it more. So yeah, so that's something like, that's a parting thought from my end. Thank you, and I think we can have questions now.
Guys, you can ask your questions in the chat box. Come on, guys. I guess it was pretty much clear to everyone, sir. That's why
Uh,
no one is having any questions.
it's either all clear or all clear.
So I guess it is clear to everyone. If you, any one of you is having any questions, you can write it down in the chat box. Okay, Afreen has one. What's your question, Afreen? Okay, so Afreen has a question, sir.
Yeah.
If I wanna do like if I wanted to do startup for my company, how I should manage the financial model?
So, Afrin, so the thing is that, you know again, you have to go back to those, four, five skills that you need. And I would say that, you start off with understanding the business model. So if you are starting a business, like, what is the, you know what are the drivers of that business? Are you using it, like, what are going to be your costs, and be very, I would say, thorough and extensive. So even the smallest of costs, or smallest of revenues, or smallest of investments should be part of your financial model. Then you, uh, you know, once you have your assumptions, once you have those inputs in place, then you build a model and see if, making an investment, like, you know with your time, with your money, makes sense or not. Because a lot of time what happens is that people, once they have an idea in mind, they want to validate it rather than, try to understand whether this is right or not. So it becomes a kind of a validation exercise. You will change your assumptions, but, be very thorough with your assumptions and try to, I would say, you know use that model to take that decision based on your assumptions. Otherwise, it becomes a validation exercise.
Okay. Afreen, I'm sorry I can't unmute you right now. Give me some time. Till then, if anyone else is having any questions, they can write down in the chat box. Yeah, sorry, Afreen, we can't. Anyone else is having any questions? Okay, so I had one question, sir. Let me ask my question if no one else. Okay, yeah, we have another question. Sir, how sensitive is the model to the changes in assumptions?
See, it all depends on, like, what kind of assumption you're trying to change. So, for example, just take an example of an IT company and a bank. So mostly an IT company would not have much of a debt on their balance sheet because it's a fairly cash business. You don't need much of an investment in an IT business. So when you are changing, so for example, you know it's just an it's a big company. For example, it's an Infosys, and it just has 100 crore worth of debt on its balance sheet. So in case there is a change of interest rate by 1%, it won't matter much to them. So whether they're paying 10 crores in interest or 11, it doesn't matter. But for example, it's a bank. The bank's total business is on borrowing and lending. So if they are not able to lend at a higher rate and their borrowing rate increases by 1%, so uh, for example, an SBI, it has a 20 lakh crore business. I think approximately about 20 lakh crores of business is what they do. So every 1% of interest rate change for them is going to impact them very, so they are much more sensitive to the interest rate change than your IT company. So it all depends on what assumption you are changing, how much impact it will have uh, on the financials. I hope I have answered your question.
Anyone else having any questions? See, if you have any questions, you can ask it, okay? There's nothing as a right question or a wrong question. You can ask anything. This is the platform where you need to be answered, okay? You can ask anything.
Tanisha, you wanted to ask something? Go ahead.
Oh, yeah, yes. No, I was just waiting if anybody else will ask. So the question that I wanted to ask, it was a very generic question. So, like, what advice do you have for someone, who's starting out in the financial modeling domain? When you, like, who wants to start out in this domain?
So I would suggest that first of all you get your basics right in terms of understanding, like your financial statement knowledge should be uh, up to the mark. Only then can you move forward. So that is the base, and I think any book on I would say financial statement analysis would do. But after that, it's more of a practical skill. So if you want to understand a business, what's driving it, maybe uh, there are a lot of reports that are published for a company. So say you are interested in understanding the auto industry, so there are a lot of reports out there just to give you an idea of how the auto industry is going to work. And one very, I would say, underrated source of understanding the business is that all the listed companies, they have their quarterly, meetings. So analyst meetings. So what, like if you go through the transcript, uh, I would say if if there are 10 drivers of the business, they are going to discuss about 8, 9. So you are going to get a very fair idea, and they also have a much more, uh, you know, stronger grip on how the businesses are going to do. So they will give you a much more clear picture. So once you have these two things in place, then you need to pick up on your Excel skills. And I think it's like you cannot learn swimming by watching YouTube videos. You have to, get into the water. So it's the same with, Excel. So no matter how many books you read, how many tutorials you watch, until and unless you go down, like get your hands dirty, it's not going to, pan out for you. So I think these are two, three things that, somebody, and again, uh, I think the more you read, the better it gets for you. So it's a knowledge industry. It's a very knowledge based industry.
Okay, thank you. Thank you.
So,
That was good.
yeah.
So we have another question. Why do companies use financial models?
So final. So for example, uh, just if you think about you know, I would say an oil and gas company, or let's not, for example, an automobile company. So Maruti Suzuki wants to, you know, they have their plants in place. They have a certain capacity. They can only produce uh, just an example, say 20 lakh cars in a year. Now, because their growth, there is a like growth in sales. People want more cars. You know, like so how would that growth come about? So you have to sell more cars, but your capacity is full. So you need to invest in a plant. You need to make more cars. So how? So now you will go ahead and make a model. So for example, I would, if I put in a plant in say Haryana or Uttar Pradesh or Gujarat, there are going to be different implications. There are going to be, from one place there is going to be more transportation cost. From another place, you might get some tax benefits. So all these things play a very important role in the decision to where to put the plant. How much capacity should I put in? If I put in, a plant with much more capacity, then it is going to be underutilized. I will be spending more money. And then if I don't, if I put in a plant which is under it, which is overutilized, like I cannot meet my demand, then what is the point of investment? Then again you have to go back, so all these decisions I think come from once you again put in your assumptions, you see, okay, how much costs am I going to incur, how much sales am I going to make, and then put in enough financial model and see whether it even makes sense to invest in a new plant. So yeah, that's one thing. Then you have to do budgeting, etc. So all these exercises, require a financial model, like how much money should go into say marketing, how much money should go into sales activity, HR, like how much should we pay the employees. So for everything you need a model.
Okay. Anybody else having any questions? I hope it's pretty much clear to everyone.
Sure. Yeah. So if there are no
If you
questions,
guys, yeah, okay, sir.
I was saying if there are no questions, then we can close it probably.
Yeah, okay. If anybody else, this is the last time. If you're having any questions, this session is about to be over. Yes, I'll take it as we don't have any more questions.
Sure.
Okay. So, as we wrap up today's session, I want to extend a heartfelt thank you to Mr. Sahil Sharma for sharing his invaluable expertise and insights into financial modeling. Your deep knowledge and practical advice have certainly provided us with a strong foundation in this essential area of finance. We are confident that the concepts and strategies discussed today will empower all of us to further our careers and make informed decisions in the financial sector. To our audience, thank you for your active participation and thoughtful questions. Your engagement is what makes these sessions so impactful. Remember, the knowledge you have gained today is a stepping stone to your future success. We hope you found this session as enlightening as we did. Please stay tuned for more upcoming webinars in our 24 in 2024 The Changemakers of India series. Each session is an opportunity to learn from the best and continue building the skills necessary to thrive in your career. Also, we keep on doing such sessions. So if you want to stay updated, I'll just share the links of our YouTube channel and our WhatsApp community. You can join them. So until next time, keep learning, keep growing, and keep making a difference. Have a great day ahead, everyone. Let me just share the links if you want to join the channel. Just give me some time. I'm sharing the links in the chat box. Okay, here you go. Yeah, the first one is the WhatsApp community link and then YouTube channel. Thank you, everyone. Thank you, guys. You can browse these links. Thank you. Thank you, Mesh. Thank you, everyone. Okay, so I'll just close this session. Thank you. Bye.